Imagine owing more than your house is worth, more than your town earns, more than your country produces in a year, and watching the bill grow by the second. For decades, that bill felt like background noise, a low hum behind a booming economy and rising markets. The world shrugged at record debts, and interest costs sank lower and lower, as if the laws of gravity had been suspended. But gravity always returns, and tonight we're asking the question no one wanted to face: why the national debt never mattered before, and why it might change everything tomorrow. You're watching Hidden Finance, the channel where we pull back the curtain on the forces shaping money, markets, and power. If you're new here, settle in. We don't shout, we decode. We tell the story behind the numbers so you can recognize the moment before it makes the news. Today, we follow the debt, how it got so big, why it stayed quiet, and why the next day may sound different. The national debt is what a sovereign owes to its bondholders, from retirees and pensions to foreign central banks and hedge funds. It's a ledger of wars fought, recessions survived, and promises made. In the modern age, countries that borrow in their own currency look immortal. They can tax, issue new debt, and if needed, their central bank can buy that debt in a crisis. That alchemy, combined with deep trust in institutions, turns government bonds into the safest asset in the system. As long as the economy grows faster than the interest you pay, the math looks forgiving. For much of the last 40 years, that forgiveness felt limitless. Globalization sent manufacturing to low-cost shores. Technology crushed prices, and aging savers hoarded bonds, pushing yields down year after year. Oil was priced in dollars, trade was cleared in dollars, and the world's central banks stocked treasuries like lifeboats. In this environment, deficits didn't scare, they soothed. Debt piled up, but borrowing got cheaper, and the interest burden shrank even as the numbers swelled. This wasn't magic, it was a regime. After World War II, the United States sat at the center of a system built at Bretton Woods, first with the dollar linked to gold. Then after 1971, with the fiat dollar backed by the full faith and credit of the US government, the post-war playbook was simple: growth, moderate inflation, and financial repression. Keeping interest rates low let countries inflate away yesterday's debts. After the 1951 Accord, the Federal Reserve regained independence, but the lesson stuck. When the stakes are existential, you cap yields and buy time. For decades, time did most of the heavy lifting. This pattern reaches back further than the modern era. In 1790, Alexander Hamilton turned a young nation scattered Iowas into a single federal debt, betting that honoring obligations would forge credibility and capital markets. Through the 19th century, America followed a rhythm. Wars sent debt surging, peacetime surpluses paid it down. The Civil War era saw debt spike, then slowly recede as growth and commodity booms refilled the treasury. Under the gold standard, discipline was hardwired, painful, but predictable. Debt mattered, but in cycles the country understood. The 20th century rewired everything. The Federal Reserve was created in 1913. World War I introduced mass bond financing to the public through Liberty loans. The 1920s roared, then collapsed into the Great Depression, and President Roosevelt broke the grip of deflation by devaluing the dollar and reimagining the role of the state. Government borrowing rose, and with it, a new view of public finance in crisis. Austerity kills, and deficit spending can be a lifeline. The idea that we owe it to ourselves began to take hold. World War II detonated the debt ratio to just under 120% of GDP, an all-time high for the United States. But even that mountain didn't break the system. The Fed pegged interest rates, the economy mobilized, and post-war growth, fueled by the G-bill, highways, housing, and babies did what math cannot. It outgrew the debt. By the mid-1950s, the ratio had fallen sharply without a single austerity miracle. The lesson was seared into the institutional memory. With growth, time heals. The 1960s and 70s tested that faith. The Great Society expanded the social contract. Vietnam widened deficits, and foreign governments began demanding gold for dollars. In 1971, President Nixon ended dollar convertibility to gold, unmooring the currency and unleashing a decade where inflation, not debt, was the true enemy. Paul Volcker's brutal rate hikes in the early 1980s broke inflation's back at the cost of a deep recession. Debt rose under Reagan, but with inflation falling and the groundwork laid for a long productivity boom, the market tolerated the tab. Then came the late 1990s, when it seemed like the United States might pay the debt down to zero. The tech boom inflated revenues, the Cold War's peace dividend shrank defense spending, and bipartisan deals nudged the budget into surplus. Alan Greenspan hinted at a world where scarce treasury bonds would force the Fed to change the way it managed money. That world didn't last. The dot-com bust, 9/11s, tax cuts, and wars in the Middle East pushed the ledger back into red ink. In 2008, the global financial system cracked. The government borrowed massively to backstop banks, rescue the auto industry, and stabilize a panicked economy. The Federal Reserve slashed rates to zero and began quantitative easing, buying treasuries and mortgages in size. Debt exploded, yet interest costs fell. The world, terrified of risk, craved safety, and the US Treasury remained the cleanest shirt in a dirty laundry pile. Through the 2010s, this pattern calcified. Growth was steady but subdued, inflation slept. Europe flirted with negative rates, Japan buried its settings at zero, and the United States enjoyed the exorbitant privilege of selling unlimited safe assets to an aging, saving world. In 2011, after a debt ceiling standoff, S&P stripped the US of its AAA rating and markets yawned. Debt kept rising, nothing broke. Then came 2020. The pandemic shut the world in place and forced a policy experiment with no modern precedent. Wartime deficits and peacetime delivered not just to banks, but to households and businesses. The Fed bought trillions, Congress spent trillions, and for the first time in a generation, money moved fast into the real economy. Supply chains buckled, demand roared back, and inflation caught fire. In 2022, the Fed answered with the fastest rate hikes since the Volcker era, and suddenly the debt felt heavy again. That was the moment the regime began to shift. With inflation high and the central bank stepping back from bond buying, the Treasury had to sell more debt into markets that demanded a higher price. Foreign central banks, facing their own pressures and watching sanctions freeze a major power's reserves after the invasion of Ukraine, became more cautious about where they parked their savings. Large holders like Japan and China trimmed exposure at the margin. The Fed moved from bear to reducer. The term premium, the market's demand for extra yield to hold long bonds, crept back from the dead. This is where tomorrow enters the story, not as a date on the calendar, but as a change in physics. The demographics that kept rates low, giant cohorts of savers are retiring and drawing down. Geopolitics is fragmenting supply chains, pushing production home, where it costs more. The energy transition requires vast upfront investment, not all of it deflationary. Defense budgets are rising, climate damage is expensive, and politics can't agree on paying for any of it. Deficits are no longer cyclical, they're structural, and markets notice. In a world like that, debt doesn't spark crisis by itself, interest does. When servicing costs climb faster than revenue, something has to give. The United States is on track for net interest to rival and then surpass defense spending, transforming interest into one of the government's largest budget lines. If rates stay elevated longer, that dynamic accelerates as old cheap debt matures and is refinanced at new, higher yields. The quiet line item becomes a thunderclap. So what happens when the bill grows louder? History offers a menu, none of it painless. Option 1, raise taxes or broaden the base, risking slower growth and political backlash. Option 2, cut spending, which is hardest where the money actually is entitlements and defends both political minefields. Option 3, inflate away the debt through higher trend inflation and financial repression, keeping interest rates below inflation, capping yields, nudging savers into bonds, and letting time do the work again. Markets will test the will of policymakers. In the United Kingdom in 2022, Unfunded tax cuts collided with markets, gilt yields spiked, and pension strategies nearly imploded until the Bank of England stepped in. That was a warning shot. Bond vigilantes can return quickly in a world of higher inflation and higher debt. In the United States, regional banks learned a painful lesson in 2023 when long bonds bought in a zero-rate world lost value as yields rose, squeezing balance sheets and triggering failures. When the safe asset becomes a source of risk, the system swivels in unison. The global chessboard is also shifting. Central banks from emerging markets have been buying more gold, trimming their reliance on any single currency. Cross-border payment systems are multiplying, and some countries are settling trade in local currencies for the first time in decades. None of this dethrones the dollar tomorrow. The US still has unmatched capital markets and rule of law, but the edges are fraying. The more the world diversifies, the more the United States must rely on domestic savings or offer higher yields to foreign buyers. Debt, then, didn't matter before because growth outpaced interest, central banks suppressed volatility, and the world begged for safe assets while inflation slept. It may matter tomorrow because the gears have reversed, interest looks sticky, inflation is harder to tame without breaking things, and supply of debt is rising into a more skeptical market. Watch 3 dials, the spread between growth and interest. The maturity profile of the debt, how fast cheap bonds roll into expensive ones, and trust in the institutions that set policy. If those dials move the wrong way at once, the old playbook ends, but endings create openings. A serious conversation about what government should do and how to pay for it has been delayed for years. It will have to happen now. Policies that raise productivity, smarter immigration, better infrastructure, education reforms, incentives for innovation can bend the curve. Long-term planning for entitlements can restore credibility. And if markets revolt before politics acts, expect a settler kind of solution: caps on yields, quiet regulations that channel savings into government bonds, and an inflation tax that does what votes won't. Before we close, a word from the place where we have these conversations. This is Hidden Finance. If this episode helped you see the system's hidden gears, subscribe, share, and join us as we map the stories behind the numbers. In a world of noise, we follow the signal. Stay curious, stay prepared, and we'll meet you here next time. When money remembers and time stops forgiving, yesterday's painless debts become tomorrow's price of truth.